Hey folks, David Frost, mystrategicforecast.com. You're here for another episode of Common Sense Market Analysis. Today is Tuesday, January 27, 2015. You're looking at a daily chart of the SPY, and it was a pretty wild day today. We had a nice gap down. Let's go over to the 10-minute chart for a second, just talk about today, because it feeds into the rest of the week. We had a nice gap down at the open, and then the market went on a hard sell. And it was a pretty ugly day out there. The Dow was down about 400 at one point, and the S&P was down like 40 points. And, it was pretty nasty out there. We hit a low on the SPY of 201.74, and then we started rallying for most of the rest of the day, and then into the late day sell-off here. But let's go back to the daily chart and talk about where we might go from here. See, the reason I wanted to bring up the intraday stuff is because under normal conditions, based on the market, what it's doing this week and what it's doing now, and the fact that it turned on time and it turned down on time and everything was lining up correctly, we really shouldn't have had as big of a rally as we did today. So that kind of throws a monkey wrench in the theory that, and here's it's not a theory, it's what the numbers work out to be, is that I believe that between, let's just call it Thursday plus or minus a day. So this week, okay, the latter part of this week, we were going to see, we still should see, by my calculations, 1997, give or take, on the S&P E-mini futures contract. And what that translates to is right around this 200 level over here in the SPY, and, a break of 2,000 on the SPX. And that was the calculation that this daily cycle turn that occurred between Thursday and Friday of last week should last about a week, and that's where we should go down to. I don't think we were going to break this low here. I drew in this blue trend line, or I didn't draw it in, the market drew in the trend line, right? So you connect this low to this low, and because we're not that far away, if we did come down to this area, we're not that far away from the 200 period, this wouldn't provide as much level of support as normally the 200-day moving average would. So what I think is, I think this line will hold if we got even down that far, but if it didn't, and we closed below that low, I think we probably go all the way down to this gap window here, and then maybe this gap fill area, somewhere in this neighborhood. That's kind of the worst case scenario for now. Call it 191 plus or minus 50 cents or so. But we're not there. In fact, the market showed some bullish tendency today, and there is a chance that we could have bottomed for the weekly bottom here, not the weekly, but the daily cycle bottom that's due this week. The top was due last week. The bottom's due this week. That could have happened today. It certainly could have. We'll know more tomorrow. And the reason why it's hard to tell right now, and I hate to give you the market could go up and the market could go down. That's not my style. You know that. But the problem is you had some unusual activity today in the middle of the day where the market rallied more than it should have based on the velocity of the sell-off this morning. And then what also is going on is Wednesday, tomorrow is the FOMC, or the Federal Reserve Open Market Committee, release of their interest rate decision or announcement. And we know it's all nonsense, but it's not what they say. It's how the market reacts to whatever they say, or however what they say is interpreted. Either way, it doesn't matter to a trader. What matters is what the market's doing with the information and which direction is it going, and how long is it taking to get there, and under what velocity is it getting there, and is it creating a pattern by which it might go lower or higher from that point. So that's what I'm looking at. I don't really care what the Fed says tomorrow. What I care is how the market reacts to whatever they do say. And the Fed, the market is, I don't want to say typically, but just to my recollection, I've never done the math, but to my recollection, the market is not down that much after a Fed announcement. But there's always that outlier, so you never know. I'm just saying, be careful. If you're short, I would take some chips off the table if you're in the money. If you're long, be careful. Know where your stops are. Know where you're wrong. And other than that, I don't really think you should be doing much around the Fed announcement. Let the market whip around. It always whips back and forth a couple of times after the Fed announcement, and then it finds its footing about 20 minutes to a half hour later, and then it goes in that direction for the majority of the rest of the day, and that's basically what you can expect tomorrow. All right, so let's move on, and you know what? I will make mention of the IWM because we normally do, and the IWM was stronger than the market today. So the S&P was down 1.34%, and the IWM was down basically 0.5%. And it was just 57 cents on the IWM. So this is the small cap index, the Russell 2000 index. So again, we're getting a divergence in the Russell from the market, and the Russell 2000 index right now is stronger than the overall stock market, or the S&P for that matter. So again, watching it, I'm just watching it, and these are signals that the daily bottom is upon us. It's coming, and even if it's 20 or 30 or even 35 points lower in the S&P from here, it could just be an intraday swing and a reversal, and if you took a long lunch, you might miss it, one of those things. So I wouldn't worry too much about it until we break, let's just go back to the S&P chart, SPY. Until we break this trend line on a daily close, do you need to worry? So other than that, I think it's just a daily cycle that will bottom within the next few days, should be this week. And then remember, we're within a larger weekly bottom, which was made down here, that should carry us to new highs over the next few weeks. So that's the bigger picture, right? So we have the smaller picture, which is day by day, and then we have the bigger picture is we should make new highs once we get this daily cycle bottom out of the way. All right, so let's move on to crude oil. Not much going on here. You know, they threatened to make a little rally today. USO was up a few pennies. What was it? It was up 34 cents. Not bad. Crude oil was up, whatever it was 1.5%, I believe, something like that. But that's not a bottom. We're not putting in a bottom yet. We didn't put in a bottom. But the sentiment is so wildly bearish that something's imminent, I think, at least on a shorter term basis or on some intermediate term basis where we can get a multi-week rally out of oil. If we could find the bottom, we can hop on the train and just go for the ride. If you play USO, you can probably get a couple of bucks out of USO. We could probably get back up to 20 to 21 area over here if we stage some kind of a rally to make everybody believe oil bottomed and the energy sector's going to be bullish again and oil's going back to 100 and all that nonsense. All they have to do is believe it for a few days and it'll take off. But we haven't seen the bottom yet, and until we do, we're doing nothing. Let's go over to gold. And gold, if you remember last night, I told you that I think that gold has such a bid underneath it that I don't even think we get to this 200 period moving average on the daily chart. This is GLD. I said we might even just get into this area here. We didn't even get there today. Basically, we just took off, and I don't necessarily think that we're going to make new highs again here on this run, although it's possible. There is a huge bid underneath gold, I believe, but I still believe it's got some more work to do on the downside in order to complete and work off some of this overbought condition and complete a consolidation pattern, which should take us out several more days. But we'll see how it plays out. It could just take off. I could be wrong. But either way, I've been telling you that higher prices are coming in gold either way. I mean, the next target is 1340 to 1350 in the price of gold futures. And that puts us up from where we are now. That basically puts us up, let's see, about $6 in the price of GLD from where we are, so that would put us at 130. So if you look at the weekly chart, what does that do to our weekly picture? If we project out 130, yeah, you'd be up in this area here. Yeah, that's certainly possible. You might even challenge this high on the next run higher, could overshoot 133, 134 in that neighborhood. So here's the deal. On the weekly basis, if we put in another couple of sideways weeks this way, then you can build momentum to go higher. And right now, I just don't think we have it. We have to work off some of this rally down here from 114, 113, all the way up to 125 in pretty short order, right? That was in 3 weeks. So we need to work off some of the overbought condition, and that's what I believe we're doing now. But you never know. Anything could happen, and it could go higher. Just don't think it will. All right. I'm going to wrap it there tonight. Hopefully this is helpful. I'm David Frost, mystrategicforecast.com. Thanks for tuning in for another episode of Common Sense Market Analysis.